Most traders set their stop loss at logical levels of price, so behind swing points, order blocks, breaker blocks, and what this does is inadvertently create big areas of liquidity or liquidity pools that institutions actually target to fill their positions before price actually takes off to its target. I want to show you how this 3R trade on GBP AUD played out by just understanding where liquidity was resting, how it was raided, and what happened in terms of a shift that we could get involved in to take a high probability trade. So let's take a look. So if we just pick up price right here, we can see that price is selling off. We're coming back into internal range liquidity, trying to go lower, but then we get a break above, creation of an order block, and price targets higher. So at this point here, we're essentially seeing the collection of a liquidity pool below these lows. So if you think about how people are placing orders, what is happening? If you're looking to get long in this move, you might want to come off the fair value gap, covering the swing point. Maybe it's a position trade. So that could be option one. You might be looking to get involved at the order block, the last sell before the buy, with your stop below the low for a continuation trade. So that's option two. If you got involved in the first move and you're holding your position, you may have got involved at this order block right here with your stop below this low. So you can see visually how orders are starting to come into the market. As price rejects this fair value gap, shifts bullish, and then targets higher, new orders are coming into the market with stops at these lows. So what does price do? We can see it very clearly. It first targets all of these lows before shifting bullish again until a move actually plays out. So this is the creation, first and foremost, of liquidity pools, areas of logical price where stop losses are accumulating, which get targeted before moves play out. I want to show you exactly how you can get involved and make sense of this. So I'm trading looking at the 12-hour time frame, and I'm combining this with the weekly, 2 weekly, and monthly candles to actually understand where I'm trading to. So I'm going to overlay the 2-week candle right here, and I'm just going to take all of this away. So we know that there are stops resting at these lows right here. We can also see that a 2-week candle has closed at this level. So you can see within this 2 weeks price action, we create a candle range. What price basically does is it looks as though it's going to go long. We get a bullish shift, we get disrespect of this price leg. So we're enticing longs into the market and building liquidity pools at these lows. Price then comes into this internal range liquidity, respects the order block, and dumps aggressively into this liquidity pool. At the same time, it liquidates the low of this 2-week candle and then shifts bullish. We now have everything we need to get into a high probability trade because we've identified the pool of liquidity that's been swept. We've raided external range liquidity at this candle's low, and we've seen a true structure shift. We've actually closed above this swing point. So we can now take a long from the order block, we can just cover the liquidation with our stop, and then we have a very natural long-term price target, which is at the external range liquidity of the candle that price is manipulating. And this turns into a perfect 2-week CRT, where you see price raid below the low and then target the high of this manipulation candle. And we can just get involved and avoid getting involved too early by waiting for this candle to close and waiting for these liquidity pools to be raided. And that's exactly how to trade liquidity pools. So let's just look at some theory before we look at another example. Liquidity pools are areas where stop losses and pending orders cluster at old highs and lows. So just think about, if you're looking to get into trades in the market, where would your stop loss be sitting? And if these are areas that are getting targeted by price, and you have trades that sit in line with higher time frame context, like weekly, 2-weekly, monthly candle liquidations, once you see a structure shift, you can look to get involved. Why does it matter? Because we want to distinguish actual moves in the market from manipulation. Let's look at another example on Euro USD. So the same thing is happening. We have 2-week lows being raided. So we had the close of this bullish candle, this 2-weekly bullish candle, and this bearish 2-weekly candle. Price targets the low aggressively and then closes inside this candle's range. So logically, the next thing that price will want to do is target the highs, which it eventually does do. But before it does that, it sweeps the liquidity pools that are building at the lows right here. So you can see if you're looking to get involved in longs, you might want to take a long from this order block right here, targeting the high. So that would be an amazing trade if it played out. You might want to get involved off this order block once it gets closed through. So the logical areas for stop losses to be building are all of the lows of these order blocks that are created in the market. Then get another order block which price respects. It trades into and then respects. So traders are looking to get into high probability swing positions. But what does price do? Instead of respecting this area here and carrying on, it dumps into all of these lows. It raids these liquidity pools before it then eventually shifts bullish. So at this point, once liquidity has been swept, we can get involved maybe from the fair value gap, covering the swing point to its original target. And that plays out for a 3R trade. So this is how to identify liquidity pools on your charts. Look for unswept liquidity, natural places where stop losses will accumulate. Wait for price to target those levels and then shift in your favor. Then take trades towards natural targets in the market, because we've raided below these lows, so the next draw on liquidity is most logically at the highs. So how to apply this? Identify where liquidity sits at key levels. Wait for price to liquidate those levels and collect the orders at those key liquidity pools. Then confirm the respect of those pools by looking for market structure shifts in your favor. Then target the next area of external range liquidity based on candle range trading. So this is exactly what I do time and time again. I trade 32 Forex pairs, including gold, silver, and Bitcoin, and I just trade them in conjunction with higher time frame candles, so weekly, 2-weekly, and weekly closes. And I wait and execute. And once you get good at this, you can do it in 10 to 15 minutes a day, and swing trading becomes a lot more straightforward. So if you're interested in swing trading content and you want to follow along, please subscribe to this video and I'll see you on the next one.